Give us a sense, though, how the coronavirus has impacted the startups in Asia.
Well, I think thanks again for having me, first of all. And so if you look at the month of February and March, a large part of the businesses were impacted severely, particularly here in China, and then now more recently in the last month or two, rest of Asia as well. And we see a significant drop on various fronts in riderships, in businesses, in services. But there are pickup in on the positive side in education services, online content, online subscription. And over the last 2 months, though, I would say that China actually sees some recovery for the month of March in things like hotels and ridership in DiDi and the likes. And so we are seeing about 60–70% recovery coming into April and the end of April.
Do you foresee any bankruptcies at all? Do you see investors losing a lot of money?
I think when the tide resides, yes, I think you will see some companies having challenges, particularly where you have offline services, retail services that is probably mostly impacted. Most of the tech companies where it's more online, they are less impacted, although short-term travel, short-term business acquisition and revenue will make it more difficult. But having said that, I think you will see companies actually going down. There will be the market will consolidate, and so the stronger players with more cash, the stronger players with more online penetration. Companies have to adapt to this new norm in terms of how they acquire users, how they reach out to users, and how they service their customers.
How are you advising startup founders? What should they be doing?
Well, I think they first of all have to look within them. A lot of times is to try to, this is the time to really rationalize a business, consolidate some of your services. You have to weed out a lot of the wastage and focus on your strength. And typically in times like this, you could also be consolidating your competitors. So really, I think is to look inside before you look outside and try to strengthen the organization, strengthen the company, and ready for a recovery growth. And that's where you could really win out the market, gain the market share, and consolidate your competitors.
Jixun, it's Yvonne in Hong Kong. Thank you so much for joining us. How are you navigating this environment right now? What's your approach in investing? Is it more of a pause and focus on your current portfolio, or is it business as usual?
Well, we have been operating very much online. We run our weekly meetings online. We met companies online, and we are gradually back to normal, where back to office 8 to 5, and meeting companies, but it will be more localized. There's still fairly limited travel even within China. Obviously, across Asia is also even more limited. So a lot of our pace of investments has definitely slowed. It takes more work and more time to do your due diligence on companies. But having said that, I think we do see investments being made with our portfolio companies. We are making new investments. So the pace is actually beginning to build up from March to now. And I think the momentum will increase over time as people try to identify the winners. Bear in mind, actually, if we look back at our investment over the last 20 years, whether it's Alibaba or Qunar and the likes, we made them in the very low point in the market. In 2003, when we invested in Alibaba, in 2008, 2009, we invested in Qunar, which later merged with Ctrip. So this is the time where you could identify some of these sort of winning companies with strong management. When the tide resides, the strong actually emerge.
How is this health crisis impacting valuations? We've seen a bit of adjustment in the near term. What are your expectations for the medium term moving forward for the next 6 to 12 months?
I think definitely that's why it's a good time to invest. So valuation has been kind of riding high for a little while with, I guess, too much capital in the market. Right now, with the tide residing, and we do see some level of withdrawals among capital. And so for those with the capital raised with the deep pockets, it is the time where you could really pick out some of these companies. So valuations, I must say, is there are still pockets of hotspots. For example, in edutech company, education technology company, companies are doing well, and so they are getting upbeat valuations. Obviously, there are pockets of lowlights. They are still good companies, but businesses are being impacted by the virus situation and the slowing down the economy. And in these cases, valuations are more reasonable, and which is a good thing as well. So it is a time to kind of pick out the winner with reasonably good value for money.
Talk about picking up the winners. You touched on DiDi and how business is coming back online. Is there a sense that DiDi could, at some point, generate a profit?
Yeah, so I think they are trying to recover, obviously, from the slowdown that we saw earlier. And they are also expanding into new services such as two-wheelers services. So they did announce additional investments on the two-wheel market, and that's bike sharing and including electric-powered bikes. We think that the whole transportation fabric will be expanded. We are also an investor in a company called Hello Bike, which has done really well in the two-wheel business. They have about 10 million two-wheelers on the street. These are mechanical bikes, including electric power bikes, and they have seen really, really strong recovery. So on a year-on-year basis, March to March, they have actually seen an increase year-on-year in terms of their ridership. So I must say that when things start to recover, when things start to normalize, people are going back to work. They are looking at alternative to public transportation.
Jixun, more and more companies are staying private for longer. In fact, some companies are getting to $10 billion in value without ever going to the market. Is this the way forward, and what does it mean for GGV Capital?
Well, I think different companies take a different route. There are companies which goes out at a couple of billion or tens of billion range, and others could wait out even longer, the likes of Alibaba and Facebook, etc. So there are, despite them not going out, for some of these mega unicorns or much larger unicorns, there is a secondary market, there is a trade in the market. So that there are exits if you choose to. The exit options are also opening up. there are rules being changed in various markets. In the past, most tech companies actually head to the US. In the more recent years, some have chosen Hong Kong. And others are now looking at China. Obviously, the STAR board, which opened last year, and more recent, just few days ago, the Chinex, the Chinex board is actually relaxing their rules or changing their rules to welcome tech companies or tech startups to list there. So the markets are opening up, they're creating more options. But I also say this, the exit environment it's a varied one. Oftentimes for investors like ourselves, M&A would be just as good an exit. And you do see some of these happening. Many of these conversations are happening as I speak. Some are my portfolio, some are others, where the larger unicorns would actually make those acquisitions, in times like this.